In today's short video, we're going to talk about the most important 10 things to do in your checklist for the next stock market crash, which might have to come very soon. What's up, guys? This is Barro today. You may not like what I'm about to say, but it's a truth proven by statistics and history. We have seen an inevitable stock market crash brewing to take place in the next 1 to 2 years. Of course, we don't know precisely when the next crash will occur, how long it will last, or how steep the decline will be. We do know that, based on the history, double-digit declines in all stock markets are more common than most investors probably realize. History is clear. A crash is coming soon. If we simply look over the common and average patterns in the history, a double-digit daily crash or big correction over the next 12 to 18 months is very likely to happen. For example, in the past 60 years, besides the recent COVID-19 crash, every single bear market had at least one double-digit pullback. More than half of those bear markets actually had 2 double-digit declines within 3 years of hitting the bottoms. We're now nearly 14 months from the COVID-19 crash bottom, but have not yet got any double-digit drop. Moreover, the S&P 500 P ratio is another warning sign. It's gone too crazy with over 2 times higher than the historical average, once again proving how crazy hot the stock market is right now. The S&P 500 P ratio is around 37 right now, while the 150 years average is less than 17. But the real concern is that each of the previous 4 times the S&P 500 P ratio has crossed above the 30 mark during a continuous bull market, subsequently declined by over 20% at least. Also, there have been almost 40 times of double-digit drops in the S&P 500 over the past 70 years. That sizable drop happening every 2 years on average. So the history is clearly telling us that a crash or sizable correction is inevitable to come very soon. However, no worry please. Market crash doesn't have to be bad news all the time, especially for wise investors and traders. As long as we are well prepared mentally and financially for the crash beforehand, it can actually be an incredible opportunity for profit taking. Rather than feeling panic, it's better to stay calm and prepared. There is a 10 key point checklist for you to survive the next stock market crash. First, take a breath. This happens all the time. The first thing to do when panic selling hits is to breathe deeply and realize that this is just the normal part of the long-term investment process. You might even call it a price admission to the greatest wealth creator on the planet. A double-digit decline has occurred every 2 years on average since 1950. But what you might not realize is that every single crash has been erased by a bull market rally soon after. In many cases, it only took weeks to a few months to recover from those sizable drops. Second, understand your risk tolerance. For instance, if 50% loss from the high growth stock is going to make you losing sleep, you better not invest in growth stock. A lot of those top performing growth stocks just had to lose half of their value during the recent COVID-19 pullback, let alone all the other crashes in history. Please keep in mind though, investing conservatively doesn't mean giving up significant wealth creation. In hypothesis, if you had bought an S&P 500 index ETF in 1980s, you would have to put up with the worst crash in 1987, the dot-com bubble in 2000, the Great Recession in 2008, and the COVID-19 crash last year. After all the hard and difficult tolerance over 4 decades, your reward is an 11% average annual return. Third, regularly reassess your holding. You don't really have to wait for a crash. Panic selling is always a good time to step back and reassess your holding. By this, I mean to evaluate whether or not your initial investment is still making sense. In many cases, the reasons you bought into stock in the first place should not be surrendered by a stock market crash or a big correction. In some rare events, your investment idea has been proven broken. It might be a good chance to sell your shares or reducing your position before any potential crash further. Fourth, ignore emotion-driven why knowing. We usually don't know what causes the stock market crash until all the noises are settled down. But the biggest drivers of all crashes are usually the emotion-driven panics from those short-term traders. We cannot control how other investors are going to behave during stock market crashes. What we can do is to lean on the history and our investment research, which tell us that crashes and big corrections are often very short-lived. Ignoring the instant emotion during stock market crashes is crucial to develop wealth over the long run. Fifth, holding cash to take advantage of discounts. Every single crash or big correction is eventually wiped out by a bull market rally. It means every major dip in history has been proven to be a buying opportunity. As long as you focus on the long term with wise strategy. Crashes are like annual sales events for us to pick the cheap. Sixth, avoid marginalike play. Aside from going emotional, the other things you really don't want to do during crash or steep correction is to raise leverage on margin puts you at risk of losing more than your initial investments, and you will be forced to pay interest on the money you have borrowed. Moreover, using leverage triggers an attempt to time the market, which cannot be done with any accuracy over a long run. Margin can be helpful when the market trend is up clearly, but it's way too risky to use during periods of rising volatility. 7. Nibble to buy frequently. It's impossible to time the bottom of a crash. The most common question asked is, when should be good timing to buy during crashes? The answer is simple. Nibbling or buying frequently. In recent years, most brokers have turned commission-free, and many even allow investors to buy fractional shares. This means that you can drop $5,000 into your favorite group of stocks or put just $5 into a fractional share of Amazon stock. You will never know how steep a decline will be or how long a crash will last in advance. It's better to nibble to buy frequently when a stock market crash occurs. 8. Add to your winner. Some experts have long believed that it's better adding up to your winners than doubling down on your losing investments. Winning stocks are winners for a reason. They're often innovative with competitive advantages and have superior long-term growth prospects relative to the broader markets or their industry. The point is, when panic selling begins, leaning on your top performer should give you a better chance to outperform once the bull market takes place after. 9. Dividend-paying stocks are the winner. Publicly traded companies paying dividends are almost always profitable and have time-tested business models. Dividend stocks usually run circles around those non-dividend-paying stocks in the long run. According to JP Morgan report, dividend stocks average annual return is about 5 to 6 times more than the non-dividend paying stocks in the past 50 years. 10. Find the right value stocks. The last but not the least, value stocks would be a smart addition to your portfolio when the selling accelerates during a crash or steep correction. Value stocks are not only profitable, but also beating growth stocks substantially during the early stage of an economic recovery. This has all been proven by statistics and the history. Alright, I have also put a short notes of the 10 key point checklist in the description box below this video. Please feel free to have a recap there. And thanks for watching again. Hopefully this will help us not only survive the next stock market crash, but also strengthen our trading and investment fundamentals. Please don't forget to strike the like and subscribe button down below with any of your thoughts and comments. Let's have more until next time. See you.